On the morning of August 1st, 2012, Knight Capital was one of the most powerful trading firms on Wall Street. By the end of that same day, it had lost $440 million in just 45 minutes, all because of a software error triggered by a single line of code. Within hours, the company's stock plummeted over 70%. By week's end, Knight was forced to accept a last-minute lifeline from a group of rival firms just to stay alive. And just a few months later, the once dominant market maker was sold off for scraps. What happened was more than a glitch. It was a masterclass in how speed without control, innovation without oversight, and scale without resilience can destroy a company in a single trading session. Today, on Business Theory, we're breaking down the $5 billion typo that sunk Knight Capital, and the urgent business lessons that every leader in any industry should learn from it. To understand Knight Capital's collapse, we have to first understand its rise. Founded in 1995, Knight became a pioneer in what's known as market making, a role that involves constantly buying and selling securities to provide liquidity. Think of them as the middleman of the stock market. When you clicked buy on a stock, Knight was likely on the other end, facilitating that trade in milliseconds. They built their business on two main pillars, speed and volume. While big banks were still relying on slower legacy systems, Knight leaned into cutting-edge technology to win trades by fractions of a second. By the late 2000s, they were executing over 1 billion shares per day. But here's the critical part. Knight's real strength wasn't just their speed, it was their dominance in retail order flow. When individual investors placed orders through platforms like eStar Trade or TD Ameritrade, Knight was the one filling those trades. That meant scale, that meant revenue, and that meant vulnerability. Lesson 1. Dependence on a single strength creates a single point of failure. Knight was brilliant at one thing, speed, but that became a weakness when complexity increased. Lesson 2. Market leadership doesn't equal market security. Just because you're big doesn't mean you're unbreakable. Knight had reach but lacked redundancy. Lesson 3. The faster your system moves, the more dangerous a single flaw becomes. In industries built on speed, a millisecond mistake can turn into a multi-billion-dollar loss. Knight had built a juggernaut, but that juggernaut was sitting on code it didn't fully understand. August 1st, 2012. Knight Capital is about to deploy a new software update to handle a New York Stock Exchange program called the Retail Liquidity Program. But something goes wrong. In one of Knight's servers, an old piece of unused code is accidentally reactivated. The glitch is simple. One parameter that was supposed to be turned off wasn't. The result? Knight's system starts aggressively buying and selling millions of shares at wildly incorrect prices. In just 45 minutes, Knight executes over 4 million trades on 397 million shares, most of them at losses. The system is essentially creating artificial demand, inflating prices, then dumping stocks at lower values. By the time they shut it off, $440 million is gone. And all because one technician copied new code to only 7 out of 8 servers. One machine was running a rogue version of Knight's software. Lesson 4. In complex systems, small errors have massive consequences. This wasn't a massive systems breach. It was a routine update, with an oversight that cost nearly $500 million. Lesson 5. Quality assurance must be treated as mission critical, not a formality. The update wasn't properly tested in a live environment. No simulation, no fallback, just launch and pray. Lesson 6. Automation without guardrails is just a risk at scale. Knight had automation systems powerful enough to move entire stock prices, and no fail-safes to stop them once they went rogue. This wasn't just a typo, it was a structural blind spot. And in financial markets, blind spots get priced in instantly. Knight's systems had been pieced together over years. Multiple platforms, legacy code, and patches layered on top of one another. There was no single system of record, no unified oversight. When the faulty update was deployed, no one immediately understood what was happening. It wasn't until the market itself began reacting with sudden, unexplained volatility that Knight realized something was wrong. And by then, it was too late. One trader later said, "We weren't in control. The system was doing things faster than we could analyze." Lesson 7. Tech debt compounds faster than financial debt. Knight had outdated, undocumented systems running critical trades. They built speed, but not stability. Lesson 8. Legacy systems become silent killers. Because they still work, companies delay replacing them until one day those systems work against you. Lesson 9. If you can't monitor it, you can't manage it. Knight's real-time visibility was so limited that it took nearly an hour to understand the problem. A lifetime in high-frequency trading. Knight's tech stack was optimized for profit, not resilience. And when something cracked, there were no buffers in place to absorb the impact. Once the damage was done, Knight's crisis wasn't just technical, it was existential. In the hours that followed, Knight tried to unwind its positions, but the market had already reacted. Their stock dropped 75% in 2 days. Their reputation was torched, and most dangerously, their counterparties, other financial institutions, started backing away. On Sunday, a group of rivals, including Jefferies and Blackstone, came together to inject $400 million into Knight, but at a cost. They acquired a 70% ownership stake, effectively taking control of the company. Knight never recovered. In 2013, it was sold to Getco, another high-frequency firm. Lesson 10. Trust evaporates faster than capital. The biggest loss wasn't just money, it was confidence. In finance, that's fatal. Lesson 11. A crisis reveals your business model's true strength. Knight had speed, but not safety. Volume, but not vision. Lesson 12. Recovery isn't always possible. Some failures don't leave room for a second act. Knight had hours to save itself, and barely did. This was no slow death. It was a flash crash of a company. The aftermath of Knight's collapse sent shockwaves through Wall Street and beyond. Regulators began asking deeper questions about the safety of high-frequency trading. The SEC launched investigations and soon after proposed tighter rules around automated trading systems. Firms were required to implement kill switches, mechanisms that could instantly shut down rogue algorithms. Knight became the textbook example of what can go wrong when automation meets negligence. But here's what's critical. This wasn't a cyber attack. It wasn't sabotage. It was a self-inflicted wound. Lesson 13. Regulation always follows catastrophe. Knight's collapse forced the entire industry to rethink safeguards. But many of those controls came too late. For them. Lesson 14. Innovation must include responsibility. Speed and automation can't come at the cost of oversight. That balance isn't optional. It's survival. Lesson 15. Leadership must be technically literate. Knight's executives didn't fully understand the systems driving their business, and when things went wrong, they had no playbook. Knight changed the way firms approached risk, but not by choice, by consequence. Let's be clear, a single coder didn't kill Knight Capital. What really killed Knight was a culture that prioritized execution over architecture, speed over safety, and short-term gain over systemic stability. The code was the trigger, but the environment, the disjointed systems, the lack of testing, the inadequate oversight, that was the real problem. It's easy to look at Knight's story as a one-off fluke, but if you strip away the specifics, what you're left with is a universal pattern. Companies that scale fast often forget to scale wisely. Lesson 16. Fragility hides in complexity. Knight's downfall wasn't about ignorance. It was about invisible risks, the kind you don't see until it's too late. Lesson 17. Business models must be stress-tested. Knight never asked, what happens if this fails? And when it did, they had no cushion. Lesson 18. Culture is the root system of resilience. Knight built a culture of hustle. What they needed was a culture of balance. In the end, the $5 billion typo was just a symptom. So what can we learn from the fall of Knight Capital? Let's break it down. First, speed without safety is a risk, not a strategy. Every system needs a brake, not just a gas pedal. Second, technical debt is real, and if ignored, it becomes financial debt in disguise. Third, automation is only as good as the humans managing it. If you don't understand your tools, they will eventually turn on you. Fourth, crises don't build character, they reveal it. Knight's collapse showed us what happens when ambition outpaces discipline. And finally, a business built on milliseconds must still take the time to double-check. Move fast, but check your code. Because in business, as in trading, the smallest oversight can become your biggest loss.